The Sunrise Battery Materials Complex project, which is completely owned by the Cleantech Holdings Limited, is entering into a new market by extracting nickel and cobalt to produce high-purity sulfates. The purpose of the project is to mine scandium, which is special material used in lithium-ion battery and can help the company to enter the rare alloy market as well. The project is expected to produce 25,000 tonne per annum of nickel and 7,000 tonne per annum of cobalt as high-purity sulfates for the rapidly growing demand in lithium-ion battery market. It is further suspected to produce 10 tonne per annum of scandium oxide, having the capacity to produce up to 80 tonne per annum if demand arises. It is estimated that the mine will produce up to 21,000 and 4,400 ton of nickel and cobalt. The project's net present value (NPV) is projected to be around 1,392 million US for an initial capital cost expenditure of 1,491 million US and a payback period of almost 5 years. The projected mine life is 40 years. I'll be going through some of the project benefits in this slide. The project brings many benefits not only to the company but also to Australia. The project will be a low-cost project as it will produce high-value metals for rapidly growing demand of the technology market and will be producing 3 products from one mine, making it cost-effective. Furthermore, the byproduct, especially cobalt, has an exceptionally high value in the market. The project has a low sovereign risk as Australia is seen as the most stable and low-risk countries for resources development, hence offering transparency and credibility to the supply chain. Moreover, the project is close to road and rail infrastructure, making it available for international market.
In analysing the financial status of Sunrise Energy Metals, it was found that liquidity and debt positions of the company are extremely strong. This was evident in the debt ratio being significantly less than 1, indicating that the company has significantly more assets than debts. And also it was found that the current and quick ratios are the same at 21.44, indicating they're easily able to meet their current liabilities. However, due to those numbers being the same, it indicates that they do not have any current inventory. This was due to the company currently transitioning between major mining projects in the 2022 financial year, and as such, their total assets turnover was extremely low at approximately 4%. And due to such low revenue, they've also had a negative return on equity. And this current transition between projects has skewed their stock price, and as such, they've got a price to earnings ratio of 2600, just due to the fact that they're transitioning between projects, and as such, that's impacted their revenue for the last financial year.
The projected cash flow statement for the final year of this company's lifespan can be seen on the slide. The values used to create these figures were derived from the annual reports on their websites from the years 2019 to 2022. However, due to the unpredicted nature of the global pandemic and the renewal and the adaptation of the project itself, the values quoted in the 2022 report were considered outliers and were averaged. One main assumption used to create the entire cash flow statement was a fixed 6% inflation rate across all 50 years. This was used in all areas of the statement, including places like the loan payments, interest received, and rental income. The figures were split into the main inflow and outflow categories of operating, investing, and financing activities. The operating activities of the companies are the receipts of customers, payments to suppliers and employees for things like salaries and raw materials, interest received and paid, and the government incentive. The investing activities of the company are the loans to be paid by the company for the purchase or rent of the property, the plant, or any equipment used in the process of mining these minerals. Additionally, there is also rental income, which is the annual income received by the company for any land that it has rented out. The financing activities of this company are the payments of the principals for the initial rental leases and the cash that has been placed into the company.
In analysing the viability indicators for Sunrise Energy's battery materials complex project, utilising our projected cash flows, it was found that the payback period for the project would be approximately 14.7 years. This is found to be quite suitable as the project is expected to operate for up to 50 years being a mine, and thus having a payback period of 14.7 years does indicate that the project would be viable. The viability of the project is further supported by the positive net present value at $136.8 million approximately, and this does indicate that the project is expected to produce profits. This is further supported by the benefit to cost ratio at 3.4264, indicating that the project is expected to produce profits and produce more benefits than costs. The internal rate of return, however, does indicate a low viability at 6%, where industry averages have found that for viable mines, an internal rate of return should be approximately 20%, and thus this value does indicate low viability. However, the payback period, net present value, and benefit to cost ratio for the project do indicate that the project is viable for operation.
To conduct a risk analysis assessment for the battery materials complex project, we underwent qualitative and quantitative analysis. In the qualitative analysis, we determined the greatest variables which would be assumed to create major variance in the cash flows of the project. These are as follows in no particular order. Inflation, regarding the cost of goods and therefore the cost of operating activities for the mine. The demand for minerals in batteries as energy storage solutions innovate within the lifespan of the project. And rolling failures due to delays, supply chain variations, equipment failures or maintenance schedules, and due to harsh weather. Quantitative risk assessment was conducted through sensitivity analysis. As shown in the spider plot graphs, the major constituents to affect the cash flows for the project are the receipts from customers. This is influenced by the demand for batteries, the demand for nickel, cobalt, and scandium in batteries, and the sale price for these minerals. Additionally, this is influenced by the inclusivity of this project in the supply chain for batteries using these minerals. The next major risk is payment to suppliers and employees. This is heavily influenced by inflation and the cost of site operations. Furthermore, this is influenced by rolling failures, creating cash inflow constraints, as well as mineral competitive marketing. In review, the company would have to circumvent these risks through budget planning to reduce the effects and probability that these risks propagate. Although the graphs depict the two largest categorized risks, which require an 88.99% and a 247.09% change, respectively, to reduce the NPV to 0 and the BCR to 1. These are considerably large changes and can be considered unlikely to occur. Additionally, in the current societal climate, energy storage solutions are slowly innovating industry, and it is unlikely that supply chain variations and the demand for nickel, cobalt, and scandium in batteries would change to then affect the customer receipt inflow for the project lifespan. Therefore, overall, while these are considerable risks for the project, qualitatively, it can be assumed that they are low in probability or will have little effect in relation to the cash flow project over the lifespan.
As of the recommendations, overall, the qualitative and quantitative analysis presented in this report are excellent. The findings indicate an overall positive viability outcome for SRK's battery materials complex project based on four project viability indicators, namely the payback period, net present value, benefit to cost ratio, and internal rate of return. This indicates that the companies understand what needs to be done in terms of resource management and allocations. Furthermore, the project site has reserves that can last up to 40 years, indicating the company's potential profitability both now and in the future. This is what develops in quantitative figures using only fixed values. It is not completely reliable for advising on project implementation. To achieve reliability, additional research on the topic should be carried out using different values, higher or lower values, for the base raise inflation payment, as well as the discount rates for MPV and PCR. Further research should attempt to explain how EVs and other renewable energy products can be used to improve IRR.